Well, thank you for joining us today. My name is Mark Montini, and my company is the Montini and Co Tax Advisory Group. Today, for the next 10 minutes or so, we're going to be talking about a subject that I think is incredibly important that we really need to prepare for, and that is the Tax Cuts and Jobs Act of 2017 expiring in the next 2.5 years. And this webinar is going to talk about what we need to do to start planning for what could happen if that law is allowed to expire. Real briefly about us, we are a tax and financial planning firm. We're a one-stop shop for all your planning needs. I am a licensed fiduciary and an independent financial advisor. I've been in financial services now for about 28 years. What we really specialize in as a company is tax reduction strategies, right? How can I help you pay less tax in retirement or no tax in retirement? We do a lot of income planning. I find that when people can see where their income is coming from, that they know it's sustainable and being taken in the most tax efficient manner possible, that it brings a lot of peace of mind when it comes to retirement. Lastly, we do taxes. Our tax returns start at 175 and they go up very modestly from there depending on the complexity of your return. Now, that might be something you want to consider, because when I'm done here today, I think you're going to see we're probably going to have to go back and start itemizing our deductions again. Now, what we're going to cover here is what exactly is the Tax Cuts and Jobs Act of 2017? What is the implications that it can have on your personal income taxes and your individual tax rates? How does this law expiring, how does this affect your required minimum distributions? Again, we're going to talk about what's going to happen to the standard deduction. We're going to talk about the taxation of dividends and capital gains, as well as child tax credits, and what you really need to be doing to prepare, because this law is going to set to expire here in the next 2.5 years. So what is the Tax Cut and Jobs Act of 2017? This was a law that was enacted by the 115th Congress and then signed into law by former President Donald Trump. The law took effect January 1 of 2018 and is going to expire on December 31st of 2025, unless we have another act of Congress that either extends the law or creates a new law that is going to be very, very similar. If this law is set to expire, as it is, and if it is allowed to expire, we're going to be reverting back to tax rates at our 2017 levels. So the question is, do you think Congress and the current president is going to let this bill expire? Well, I think the biggest concern that I have is that we're now at $32 trillion in debt. And by letting this law expire, you're going to see how taxes will dramatically go up. And I think that Washington is going to look at this and say, well, we need the revenue, so let's just go ahead and let this thing expire. So here's what where the personal tax rates are going to be headed. Okay, under the Tax Cuts and Jobs Act, okay, we're still at 0 up to 22,000, and then the next bracket is going to go from its current rate of 12% up to 15%. Now, that may not seem like much. It's only 3 percentage points. But when you really look at the numbers, that's a 25% increase in personal income taxes. Okay. The next tax bracket has a 13% tax increase. Okay. The next bracket has a 27% tax increase. Okay. The next bracket is a 16% tax increase. The next bracket's a 37% tax increase. I mean, these are big tax increases. And by Congress simply letting this law expire, we're all going to be paying more for taxes. And we're all paying less right now at this moment. And that's why I think it's so incredibly important that we have 3 tax years. We have 23, 24, and 25 that we can take advantage of the tax rates as they are right now to help us better prepare for where taxes potentially can be going. One of the implications on required distributions. Well, first off, let me be very clear. The expiration of the Tax Cut and Jobs Act has no impact on required distributions alone. Okay. However, the required minimum distribution age is now 73 years old. Okay. Now, what that means is because they've pushed it back from 70.5 to 72 to 73, by pushing that back, that is going to increase the size of what your required distribution is going to be. And with the expiration of this law, you have a larger distribution that you're going to have to be paying higher taxes on. So we really, really need to start planning for your required distributions and what the expiration of this law means. Now, for the purpose of time, I'm not going to talk any more about required distributions, but I would highly encourage you to go to my website, montinico.com/RMD, and watch. I've got about a 10 to 15 minute mini webinar that goes into great depth about where required distributions were, where they are going, and how you can prepare for it. So montinico.com/RMD. Standard deduction. Okay. Under the Tax Cuts and Job Act, okay, the standard deduction is indexed to keep up with inflation. That means that each year that the law was in effect, the standard deduction increased. Okay, and where it's potentially going to be going is if you're a single filer, okay, if you're filing as a single, your standard deduction is currently $18,850, and it's going to revert back to $6,500. If you're a married couple, okay, your current standard deduction is $27,700. If this law expires, it's going to revert back to pre-2017 levels, which was $13,000. Okay. When the law first came out, for a married couple, the standard deduction was $24,000. Okay. Now it is $27,000 because it was indexed to keep up with inflation. Head of household's going to go from $20,800 down to $9,500. Now, what does this mean? Okay. Unfortunately, what this means is we're going to have to sharpen our skills again and go back and learn how to start itemizing our personal deductions. Okay. An easy way to do that is if you just go to Google and put in IRS form Schedule A, right? Schedule A is where your itemized deductions go. And just look at that document and you can see all the personal items that you can deduct. And but you might want to sharpen up a little bit on that, or come to a tax planning firm like mine, let us do it for you. But this is something I think is incredibly important. The standard deduction has really been, the increase in standard deduction, I think, has been incredibly important for people, and seeing it revert back to where it was before, I think can be a little bit of a detriment. Capital gains and dividends. Okay, under the Tax Cut and Job Act, okay, the tax rate for people making under 77,000 was 0%. And then for people making 77,000 to 479, the tax rate was 15%. Post Tax Cut and Job Act, okay, where we're going to revert back to is people would be at a zero tax for people in the 25% tax bracket or less. And then for people in the 25 to 35% bracket, it's going to be 15%. And for people above the 35% bracket, that's going to be 20%. The child tax credit, okay, under the current law, as it is right now, there's a $2,000 credit for each child under age 17. For joint filers making up to $400,000. For joint filers making more than $400,000, they don't get the tax credit. Now, post Tax Cut and Job Act, where we expect things to be going, is that child tax credit is going to decrease from $2,000 down to $1,000, and that's only going to be good for joint filers making under $110,000. If people make over $110,000, there will not be a child tax credit. Now, what does all of this mean? Okay. The reality is that I think this law is going to expire. Congress needs the revenue, and I think that the political environment is such that, you know, the media dubbed this law as the Trump tax cuts. Well, I don't think any member of Congress wants to do anything that's going to put former President Trump in a positive light. So I think the writing is on the wall. Taxes are on sale. Okay, take advantage of that. Taxes right now are on sale, and they're going to be on sale for 23, 24, and 25. So we've got 3 years that we can be proactive to take advantage of where our low tax rates are today. And for me, when I was doing my research to create this little mini webinar, the biggest thing that jumped out to me, especially for people approaching retirement, is that we need to start converting our taxable retirement accounts, like your 401k, your IRA, your 403b, your 457. All of these are taxable retirement accounts. And what we need to do is start converting those taxable accounts into tax-free Roth accounts. Okay. Now, a Roth IRA is a non-deductible tax-free IRA. That means you will be paying your taxes on the conversion at this moment in time while taxes are on sale. Okay, you're going to be paying your taxes on those things now. And when the distributions come out, those distributions all come out tax-free. Now, with a Roth conversion, there are no income limits on who can convert or not. So anybody watching this, regardless of what type of income you have, you can convert your taxable IRA into a tax-free Roth. Again, we're going to be paying these taxes up front right now while taxes are on sale. Okay. Any future earnings that we make on that Roth account and any distributions that come out all come out tax-free. Most importantly, Roth distributions do not affect the taxation of your Social Security benefits. Okay, Social Security, how much tax you pay on that is a function of the income you have other than Social Security. That's IRA distributions. Okay, but Roth distributions do not count as that. So you can have $50,000 in Roth distributions, and none of that counts towards how much tax you're going to be paying on your Social Security. Again, for the sake of time, I encourage you to go watch. I've got a 12-minute mini webinar on the power of the Roth IRA. Okay, you go to my website, montinico.com/Roth-IRA-conversion. Okay, I've got a lot of mini webinars. Okay, this is going to be my 8th miniature webinar that I've created. You can again go to my website if you'd like, and you can go to montinico.com/webinars. Okay, montinico.com/webinars, and you can see all 8 of my mini webinars, all meant to help educate you as you approach your retirement. I encourage you to sign up and set up for an appointment. Okay, schedule a no-cost retirement evaluation. Let's see where you're at. Let me put together a retirement income plan for you, and then let me do a corresponding tax modeling system to see what your taxes are going to look like when you retire. Okay, and you can go to sign up for that free evaluation. You can go to montinico.com/retirement-evaluation, and you can schedule a time for a 30-minute or so, 40-minute evaluation on where you're at. Keep your education going. Okay, I've got a lot of video content. As I said, I've got 8 miniature webinars to date, and I'm going to keep creating more. So to see those, you go to montinico.com/webinars. But I also have more video content that I really like, that I asked my retirement clients to email me what their biggest concerns were before they retired and what their biggest concerns were after they retired. Okay, and I simply responded to what they asked, and I think as my marketing goes, this is probably the most authentic videos that I've ever put out. So I encourage you to go to montinico.com/retirement-questions. And then lastly, if you enjoyed this content, if you enjoyed my other content that I've put out, please tell your friends and family about it. Retirement's a lot more fun when you can do it with friends and family. Thank you, and wish you the best, and hopefully we will see you for a retirement evaluation.